excited to talk about debt today. As exciting as debt can be. Getting out of debt's exciting, I guess.
Yeah, indeed. Okay, well, should we start with a bit of a what is debt and how
Yeah,
does it
let's
work?
do it.
All right.
Yeah.
So,
Cool. Well, let's do our intros first. So first off,
good idea.
I'm William Glass. I'm the CEO and co-founder of Ostrich.
Yeah, and I'm Andrew. I'm the COO and the other co-founder of Ostrich.
Yeah, and we are doing these lives to help kind of talk a little bit about personal finance. So if you've got any questions throughout the chat, feel free to just drop them in the comments and we'll be sure to address them. Or if you just don't feel comfortable sharing, then don't worry, you can DM us and we'll take the conversation offline.
Yeah, absolutely. All right, so we can do a little bit of a kind of what is debt, how does it work, why does it matter, kind of brief basics to begin with, I think. Debt is just borrowing money, right? There's lots of different types of debt, very common ones. Most people have, or a lot of people in the US at least, have a mortgage, right, to buy a house. That's kind of your most common piece of debt, but people take loans very frequently, whether it's to buy a car, sometimes it's credit cards. You have lots of different types of debt that we'll get into. And the way that it works is, Will, if I borrow money from you, I'm in debt to you. You give me money, I pay you interest, right, in the meantime, which is a small amount of money that is basically a fee for borrowing the money from you. And then at the end of a given period of time, usually after a given period of time, I have to pay you back the money. Sometimes I pay principal payments in the meantime. It's called amortization. That's paying back some of the money that I've borrowed from Will, a portion of that to reduce the risk to him. And the higher the more risky the debt, the higher the interest rate is going to be, which is that fee that you have to pay to borrow the money. So those are kind of some of the basics. I don't know if there's anything else, Will, that you think we ought to throw in there before we get into anything deeper.
Yeah, I mean, I think you've done a good job, right? Debt is just borrowing money from someone, something, some entity, or something like that. And as you said, interest rate is the cost of borrowing that money, right? People aren't just going to give you money for free and say, "Hey, pay me back whenever." That doesn't happen. So the way that they get paid back for offering that service of giving you money up front is through interest. And what dictates how much interest you pay is your credit score. Well, there's a couple things. It's credit score, and then we'll talk about, for example, a secured versus an unsecured loan and what that means. But yeah, your credit score, which is essentially just how trustworthy are you? How likely is this person going to be to pay back the money? And the more likely you are to pay it back, the less risky it is to the person lending the money. So they'll give you a better deal, meaning it won't cost you as much to borrow the money. So that's the whole point of why credit scores matter and how they play into the interest rate. And if you think about interest rates, we talk about like your rate of return from an investing perspective, right? You want a higher rate of return because that means that you're making more money and your money's making money more quickly. In the case of debt, it's the exact opposite. You want a low interest rate because that means that you are having to pay less to borrow that money. So that kind of gets into the question of, is there such thing as good versus bad debt?
Yeah, which I think we both agree the answer is yes. Some debt is definitely better than other debt. At its best, debt is a tool that enables you to do things you wouldn't otherwise be able to, right? I may not be able to buy $1 million house, but I might be able to afford to put $200,000 towards it and borrow the $800,000 to buy it and live in that, presumably much more spectacular house that's worth $1 million rather than if I was just paying for the whole thing for 200,000. And on the other end of the spectrum, if I'm borrowing money to finance a gambling habit, I think we can agree that that's probably bad debt, and it'd be better not to be not to be doing that.
Yeah.
So yeah, there's definitely good and bad debt, and you always want to aim for the good debt. There's some people I think have the opinion that any debt is bad and that you should always strive to be debt free, and I think that that's really kind of a person to person decision, right? If you personally feel better when you have no debt whatsoever, that's great, and that can be your aim, and you want to pay down all of your debts, and it might be you want to pay them down really aggressively. But if you're comfortable with some debt, some debt can be good, and it can enable you to do things you wouldn't otherwise be able to do.
Yep. And if you do follow the personal finance space, this is a rift, so to speak, right? There's the Dave Ramsey's of the world, where all debt is bad debt, pay down everything, mortgage debt, all that kind of thing. And then you've got your Robert Kiyosaki's who say, hey, debt's good if you use it for buying assets and things that will give you more money. So we're not going to get into that today, but it's just something to be aware of, that you're going to hear people say debt is bad, debt is evil, debt is actually okay. And they're going to be coming from a different lens, but it's important, as Andrew said, to recognize your own relationship and how you feel when you have debt at all, or some certain types of debt. So that's going to kind of dictate what we talk about today and how you apply the concepts.
Yeah, and so let's do it, right? Let's jump into some different types of debt. I think we can start. Let's start with secured debt. This is your mortgages, your car loans, right? The key characteristic of secured debt is that it's backed by an asset. So in the case of a mortgage, that's the house, right? If I don't make my repayment on my mortgage, the bank can decide, okay, I've lent you this money, you're not paying me back, I'm going to take your house because you're not paying down your debt, or you're not making interest payments on your debt. So there's some collateral, right, that reduces the risk to the lender. So because of that, usually they're able to charge you a much lower interest rate than you would see on debt that's not backed by an asset. So that's kind of the key characteristic, and this is more likely to be what you might consider good debt, right? Where it's less risky, it's not costing you as much money to borrow that cash, and so you're able to sustain borrowing it for longer.
Yeah, like the bank, to Andrew's point, if you're trying to buy $1 million home, or you're trying to buy something for $1 million, a home, they're willing to give you that, $800,000 loan for $1 million house if you put $200,000 up. But if you go in there and say, hey, I want to get an $800,000 loan to go buy this $1 million thing, or I just want it, they're probably not going to give it to you, right? So that's where the secured debt plays into the type of debt that you can get and the amounts, and to your point, like the interest rates. There are other types like auto loans, right? That's backed by the car. So you don't actually own your car until you pay off your auto loan. You may think you do, but you do not. Miss some payments, and there might be a repo man coming there to drive your car away. So, these are things to think about, right? So the lender has recourse to seize essentially whatever asset you put up as collateral.
Yeah.
And actually, I want to jump into this one other piece on secured. So if you're just starting out and you don't have a credit score, or maybe you've got, someone that's just turned 18, you can use secured debt in a really good way to build up your credit. So for example, when I was like 19 or 20 years old, I ended up getting a secured personal loan to build up my credit, because the way that your credit score works is that you need to have credit history and on-time payments. And if you don't borrow any money, how do you do that, right? So you want to build up your credit score before you have to go buy a house, because if you don't have a credit score, you may not get approved, and you may not get good terms if you do get approved. So you can open something called like a secured personal loan or a secured credit card, where you essentially put up the money. So I would put $500 down in a personal loan, and I wouldn't be able to touch that until the loan was paid back. And then they'd give me $500, and there'd be a small interest rate, and I just automated the payment. And so this was going on, and it looked like I was making all these payments and borrowing money, but it was a secured loan, and they were able to give that to me because, again, there's no risk, right? I'm borrowing $500, and they have my $500. So this is a great way to build up credit.
Yeah, really important.
So you don't have to be 18. You can actually start building credit when you're younger, but you have to, which is a great question, mind over matter teacher, but you have to be with an adult who is over 18. So like a lender legally can't give a 16-year-old a loan or a 14-year-old a loan because they're not an adult. So you have to do that with a parent or a guardian or someone that will co-sign for you, which also means that you've got to hope that person is trustworthy. But no, you don't have to be 18 to start building credit.
Yeah, that's good. And that's like definitely something to think about, because particularly for kids going to college, it's a good time to have credit, or to be building credit. And if you can, the sooner you can start doing that, the better, the easier it gets. So doing a secured credit card for a son or a daughter that's like, you know, $300 or even maybe even less, right? You have a very low limit. There's low propensity for them to be able to do anything crazy. But you can, you know, you can build their credit that way, which is super helpful as you get older. It sucks to come out of college, realize that you have no credit score, and it's really difficult to get an apartment, or even like cable. You know, they do a credit check, and if you don't have it, it's hard to even get approved for cable. So
Yeah.
definitely worth doing.
Yeah, which is where the idea of a cosigner comes in. So if you hear someone say cosigner, that's someone that will essentially say, hey, I am going to essentially put my credit on the line and vouch for this person. So that's what happens a lot of times when you're first starting out, when a parent has to, a parent has to cosign, or another family member, you're essentially vouching for that person that they're going to pay that money back. So yeah.
Yeah. Okay. So unsecured debt, right? Different type of debt where, as the name suggests, right, it's not backed by an asset. So these are things like personal loans, credit cards, where you're able to just borrow money, and there's nothing kind of holding you to that other than the fact that you have a contract to pay that money back, you know, with this, and it's going to harm your credit score, and, you know, ultimately lenders can come after you and seize your assets in court, but it's a much lengthier process. So these types of debt tend to carry much higher interest rates, right? It's more risky for the lender, and so credit cards in particular tend to have particularly high interest rates if you borrow money through them. It's a very bad way to borrow money. Would not recommend doing that. And then personal loans as well, usually higher than your kind of your average interest rate, but can be helpful in certain cases.
Yep. And so that's, you know, pretty much unsecured, right? No asset. So that's pretty straightforward. And one of those types, right, is, and this actually falls into a separate category, is student loans, right? Because you're not backed by anything, right? Now, obviously, these fall into a special category because as long as you're pretty much going to college, you can take out student loans. And obviously, there's nuances to that. But they're also a little different because the loans that we've talked about before, there are certain ways where if you end up in a position where you're not able to pay those back, you can negotiate with your lender. With student loans, they fall in a different category. So you might hear people filing for bankruptcy, which we'll talk about a little bit later. But you can't do that with student loans. They're a very special type of loan that is meant to help people become more educated and get a better job. And that's kind of the concept behind student loans and why they exist in the way that they do, because, you know, you can go get that education, and then if you could bankrupt right out of them, why wouldn't you do that as an, you know, 20-year-old with no money, or 22-year-old with no money that just graduated college? So that's why they fall in this kind of unique bucket, at least in the United States.
Yeah, particularly when they're federal student loans, right? The lender is the US government. The government is incentivized to educate more people, and so they charge you a lower interest rate to borrow money from them, and there's a needs-based aspect to it as well. So they tend to, it's kind of a unique category, and you can think, you know, the private student loans obviously carry higher interest rates. Some student loans you might consider good debt, some you might consider bad debt. Really difficult to say whether it's good or bad, right? Depends on how much you're borrowing, what do you value your education at, and what's the difference between the job you got because of your education versus the job you could have got without getting that education. So there's lots of things to think about there. Obviously, people talk about student debt as being a potentially huge issue in this country. You know, sometimes it's good, sometimes it's bad. Again, you need to think about what makes sense for you when you're thinking about whether you should be taking out loans to go to college or not.
Yep. And how much and when you start paying, right? Because you don't have to pay on student loans until 6 months after you graduate. You know, and if you end up going to grad school, then you can continue to defer them, but the whole time those loans are accruing interest, and you borrow more money. And so this is why, you know, after 6 years, if you end up going and get a master's degree, you can end up in, you know, hundreds of thousands of dollars of student loan debt, especially if you go to expensive schools. So there's a whole lot we can talk about. There are obviously some unique programs that are targeting student loan borrowers. If you've been paying attention, then and you have student loans, then you know that you haven't been forced to pay those, and they're not accruing interest right now as part of the COVID relief packages that started in March of 2020. So that's been going on, and coming up in May 1st, you'll have to make your first payment, and things will start accruing interest again. So there's some thoughts around how you approach that, and we talked about that briefly a couple weeks ago. In terms of strategies around student loans. If anyone has any questions, we can dive in deeper, but otherwise you can listen to that conversation. The other thing is that there's some programs where you can get student loan forgiveness. So if you work in certain jobs in the public sector, there are ways where you can have receive loan forgiveness. Education is one of those. If you work in a school that is classified as high needs, and you work in that for 5 years, you can get up to $17,500 of your loans forgiven. So there are some different programs out there. There's also some unique things with loan consolidation, using loan consolidation, which we'll talk about here shortly, as a way to kind of lower those, but that also might affect whether you are approved for loan forgiveness. So there's a lot more detail that we could get into. We could probably spend a whole hour just talking about student loans. But that's just a general kind of overview and context for everyone.
Haven't even touched on companies that offer student loan repayment as a benefit.
Yep, and that's going to be treated different than forgiveness too. If you notice, repayment and forgiveness, one of them has tax consequences, the other doesn't. If your loans are forgiven, the debt is wiped away, you don't receive any money, it doesn't count against you tax-wise, you get someone repaying it for you, that counts as income, and you pay taxes on the money that's going towards your student loan debt. So it gets real tricky real quick.
Yeah, there's a lot there. So feel free to send us questions if you have those on a deeper level, and we'll be happy to go into those separately. But for now, let's talk about repayment of debt. So, I think, as we mentioned earlier on, right, it's kind of up to you as to whether you're comfortable having some debt, or if you really you don't want to have any debt and you want to repay more aggressively. But we can run through some strategies for what to do based on kind of where you stand and how much you're able to afford to pay towards your debts. So we can start with, like, if you can't afford to make all of the minimum payments on debts, right? That's not a great situation to be in, but obviously it happens to a lot of people. The important thing to keep in mind here is that the best approach is to keep as many of your debts current as possible. So you pay as many minimum payments as you can, and to be consistent with that. So if you have, $100 to pay down 3 pieces of debt, each has a minimum payment of $40, then, you should pay down the same 2 every month that you can afford, and you let the one, that has the lowest penalty for not paying, kind of accrue. And then you end up in a situation where you're only negotiating with one party over debt that you haven't paid, as opposed to, I've paid $33 towards each of my debts and haven't made the minimum payment on any of them. And then now all of a sudden you have to you've missed 3 different payments with 3 different lenders. You have to talk to 3 different creditors about how you're going to make your debt current again. So definitely important to think about, in that scenario, keeping as many debts current as you can.
Yeah. And that's obviously going to depend on what they are, right? Like if you're talking about an electric bill, a water bill, roof over your head, there's different, like, that's obviously going to affect which ones you target. So it may not be the ones that you can prioritize. But this is a situation that a lot of people end up in. And it's, important to recognize that if you are in that situation, it's okay. You'll figure out there's ways out of it, and we'll talk about some of the different ways out of it. But make sure that you can stay up to date on the ones that are most important for your livelihood. And I think that's a key piece. And so when we talk about some different ways to handle debt, there is something that we talked about, which we mentioned earlier, which is, or not earlier, but debt consolidation, right? So this is one strategy that you can use. So if you have, for example, a number of student loans, or you have 4 or 5 different credit cards that are outstanding, you can consolidate those loans. And what that means is that you essentially go to a loan consolidation provider who pays off those balances and brings them into one payment. So rather than having to pay, 5 different credit card providers, what you do is you work with a loan consolidation provider that brings them into one. And the idea is that you bring the interest rate down because credit cards have some of the highest interest rate out there. So it's a way to get out of high interest rate debt and make things more manageable. So you're only managing one payment. So you'll see a lot of different ads. And this obviously is a little bit different if you're current or if you are behind on some of those. It also affects how this works. But at the end of the day, creditors want to get some money back. So they will work with you if you do end up in a position where there's one that you're just a debt or 2 debts that you're just not able to handle. Because at the end of the day, they want some money, even if they're not going to get the full amount.
Yeah, definitely. And then kind of another sort of wrinkle there is refinancing, right? Somewhat similar to debt consolidation in a way. Usually, you might do this. You'll see this with mortgages, where if interest rates are falling, then people will try to refinance their house to take advantage of a lower interest rate. You might also see this to take advantage of a rise in value of a home, right? You refinance, you pay off the old mortgage, your new mortgage, you can get more money because the home is worth more, and that gives you access to some additional cash.
And yeah, refinancing, obviously it's going to depend on what the purpose is. This did get a lot of people in trouble, and leading up into 2008 of refinancing, pulling money out of the house, and then values dropped, and now creditors were saying, hey, you've got to pay these huge payments on houses that are now worth half of what they were previously. So things to think about, but refinancing is another option that you do have, and to get a lower interest rate when used appropriately makes a ton of sense. And then the last kind of piece on this, if you're not able to afford your debts, is bankruptcy, which is actually a really good tool in your arsenal if you use it appropriately. Essentially, bankruptcy is recognizing, hey, you know what? I am just fully underwater. There's no way that I'm going to be able to pay back all these outstanding debts. I've just gotten in too much trouble, and I just don't have enough income. There's no way I'm going to be able to pay all this stuff off. And so essentially what you do is you file for bankruptcy, which is a legal procedure, and you sit down and you negotiate with your creditors through the court systems. And it's interesting because it can feel like bankruptcy obviously is not where you want to end up, but if you do, it is a really good tool that can help you get back on track towards your financial goals and help you get out from underneath some of the challenges that you have. So there's different types of bankruptcy, and if you are going to do it, it does make sense to talk to a bankruptcy attorney, because there are things that you can do leading up to bankruptcy to protect some of the money that you have saved. So for example, I don't know all of the details, but there are certain ways where you can protect retirement accounts. There's certain ways where you can still keep a house and a car. And this all depends on what you've been keeping current. So again, we're not going to go super deep into this. It can be very complex, and everybody's situation is different, but it can be a really good strategy to use if you do end up in this position where you're in a tough spot.
Yeah, like obviously you don't want to be ending up in bankruptcy, not ideal, but it's not the it doesn't have to be the complete disaster that I think it always is in a lot of people's minds. It feels like a last resort, and maybe you want to exhaust all your other possibilities, but it's not the end of the world if you go through bankruptcy. I think is what we're getting at.
Yeah, and companies do this all the time, right? There's some companies that end up in tough spots and they go and renegotiate. So again, there's different types. So there's personal, there's companies that do this. Like for example, Hertz, right? They filed for bankruptcy at the beginning of the pandemic and kind of restructured, had a chance to negotiate with their lenders, get some of the debts under control, and they're still operating as a company. So it's a strategy that is used broadly throughout our economy.
It's a smart way to boost your stock if you're Hertz, right? Just to get flying.
Yeah, it's a whole nother conversation of people that are investing in a company that filed bankruptcy.
Indeed. So kind of for on a slightly more positive note, you can afford to make all of your minimum payments. That's great, good for you. That's excellent. So when you can consistently do this, right? Especially if you've got high interest debt, it can be a pretty good idea to use any additional cash you've got to pay down some of this debt more aggressively. I think last week we did a run through of sort of the hierarchy of your personal finance needs and where we see, the best use of the next available dollar. But high interest debt pay down is pretty high on that list. So, thinking about this gets back into what's good debt and bad debt, and that's kind of a personal question. But things like mortgages, federal student loans, they're often low enough interest rates that you don't necessarily need to worry about being super aggressive in paying those down. If you invest money instead of paying down that debt, you might get a better return in the market than the money you pay in interest. So that those two and any other low interest debt is worth thinking about whether it's worth plowing money into paying those down. But for things like credit cards, personal loans, and sometimes car loans as well, it can definitely be worth being more aggressive, paying down that money, and making sure that that you can get your money working for you.
Yep. And I think that's you bring up a point that we talked about earlier, Andrew, right? Is that interest rate. So the interest rate on your high interest rate debt is going to burn a hole in your pocket quicker than you could ever invest that money and have it come back to you. Yep. So that's why if you have credit cards, auto loans, you typically want to pay those down quickly. And then if you've got something like a mortgage or student loans that have interest rates that are 3% or sub 3, you don't necessarily, unless that's just something that feels good, is to pay it off. You could invest that money, and based on historical returns of an S&P 500 index fund, you could make a lot more in the markets, 7, 8. I think historically it's around 8%. The S&P 500's returned over the last, 50 plus years. So that could be a really good way to make that up. And what that means is that you've got 3% interest on your mortgage, but you're making 8% on that money. So rather than putting that extra $100 towards the debt, you put it and invest it, and you kind of make that difference. So again, it's going to depend on your goals. It's going to depend on your financial situation. It's going to depend on how you feel about being in debt and how you feel about investing. And so we're not here advocating for a specific way, but just kind of giving you that context so that you can think about it from your own perspective of how you feel in that situation.
But if we were going to advocate for a specific way, there's a couple of different debt pay down strategies. The one that we like the most is Avalanche. Saves you the most money in interest payments. Is where you focus on your highest interest piece of debt for each additional dollar. So you always try and make all the minimum payments. Once you're making all your minimum payments, then every incremental dollar mathematically should go towards your highest interest piece of debt. It will cost you the least if you pay that down first and then move to the next piece of debt that's got the next highest interest rate, and then pay that down and keep going through it that way until you've paid off all of your high interest debt. We like that because it costs you the least money. Another kind of well-known approach is a snowball approach, where you just tackle your smallest piece of debt first, with the idea being that you snowball, you build momentum as you pay off each piece of debt, and then by the time you get to your biggest piece of debt, you feel like you're capable of working your way through it. This can cost you a lot more in interest payments, depending on how large your pieces of debt are and what the respective interest rates are. So, if that's the way that's going to be the only way that you can pay off your debt, then great, it's the way for you, right? It's the right approach. But ideally, you would follow the Avalanche approach and go that way.
Yep. So yeah, and if you want an example to highlight it, let's just say that you have a credit card debt that's $100, but it's at 20% interest. You've got a auto loan that's at 15% interest, and it's $300, and then you've got a personal loan that is $50 and it's at 4% interest. So if you're doing the Avalanche method, you're going to target the highest interest rate. So you're going to go for that credit card, then you're going to go for the auto loan, and then you're going to go for the personal loan. Whereas if you're just doing the snowball, you're going to go for the smallest dollar amount. So you would pay the personal loan first, then you would pay the credit card, and then you would pay the auto loan. So hopefully that made sense. But that's what we mean by Avalanche versus snowball. Sometimes they line up where they're the same method, but not all the time.
Yeah. Cool. Any other thoughts? Anything else we want to touch on?
I think, you know, when we're thinking about debt, there was something that I wanted to say and I've now forgotten it. So
So how important was it?
Yeah, it must not have been. If there's any questions, you know, obviously feel free to shoot those out.
Yeah, we'll be here. We'll be available to answer any questions, and we'll be back next week. Same time, same place, doing the same thing. Well, not that. Do a different topic next week, but yeah.
Yeah. So hope you enjoyed it. We are going to be releasing the app soon.